Welcome to the debate. Today, we are opening the hood on the financial engine that powered the global economy for a decade before spectacularly blowing it apart. We're talking about the collateralized debt obligation, or, the CDO.
Mm-hmm.
For most people, that acronym is a scar, a remnant of the 2008 financial crisis that just signifies greed and recklessness. But if we strip away the Hollywood narrative, the hindsight bias, we find something else. A piece of financial architecture designed to solve a really fundamental problem of capitalism. How do you move risk to the people best equipped to handle it?
And I would argue that what we actually find is a mechanism designed to hide risk from the people least equipped to understand it. You call it architecture. I think the popular consensus and, frankly, the historical record suggest it was more like a magic trick, a way to take, radioactive financial waste, wrap it in a complex legal structure, and somehow sell it as gold.
So the central question is whether the CDO was misused or whether an instrument that relies on that level of opacity should exist at all.
Exactly.
Okay, so I'll be representing the view that the CDO was a triumph of financial engineering, a tool for efficiency that was unfortunately compromised by bad inputs.
And I'll take the position that the CDO is inherently flawed, a weapon of mass destruction, to borrow a phrase from Warren Buffett, that incentivized predatory behavior and made the entire system incredibly fragile.
All right, let's get into it then. To understand the CDO, we have to go back, way before the housing bubble. We have to go back to the 1980s. The first private bank CDO wasn't about subprime mortgages at all. It was issued in 1987 by Drexel Burnham Lambert, and it was all about corporate debt. The problem it was trying to solve was liquidity. Banks had all these loans on their books, loans to companies, aircraft leases, emerging market bonds, and they were tying up their capital.
Right, so they wanted to clear the decks.
Exactly. They couldn't lend more money because their vaults were just full of these IOUs. The CDO allowed them to bundle these diverse loans into what's called a special purpose entity. Just think of it as a separate company created just for this pile of assets. This entity would then issue bonds to investors, and suddenly, the bank has fresh cash to lend to new businesses, and investors have a new way to earn interest. In its pure form, this is, the lifeblood of a healthy economy. It keeps capital moving.
Moving is a very generous term. I think laundering might be a bit more accurate. While I'll grant you that the early days of corporate debt CDOs were relatively stable, you're glossing over the core mechanism that made them so dangerous. It wasn't just about selling off loans, it was about tranching. This is the alchemy. You take a pile of risky loans, you cut them into slices, and then somehow you tell a pension fund that the top slice is as safe as a U.S. Treasury bond. That creates a false sense of security that just permeates the entire system.
Well, it's not false security if the math holds up. And let's clarify tranching for everyone listening, because this is really the technical heart of the matter. Imagine a waterfall. The money coming in from all those loans, people paying their debts, that's the water at the top. It flows down into a series of cups. The first cup to get filled is the senior tranche. This is the safest spot. If there is any water flowing at all, the senior investors get paid first.
And they get that coveted AAA rating.
Correct. Because they take the least risk, they get the lowest interest rate. Then the water spills over to the mezzanine cup, the middle layer. Higher risk, higher return. Finally, whatever is left over splashes into the equity cup at the very bottom. These investors, they take the first hit if loans start to default. If the water stops flowing, their cup stays empty. They take the losses so the senior investors don't have to. It's a brilliant way to segment risk. A conservative pension fund buys the senior cup, a high-rolling hedge fund buys the equity cup. Everyone gets what they want.
That is the textbook definition, and it does sound elegant. But let's look at the reality of that mezzanine cup. This is where the whole scheme started to rot. By the mid-2000s, banks were churning out mortgage-backed securities. Everyone wanted the AAA slice. But, nobody wanted the mezzanine slice, the BB-rated bonds. They were too risky for the grandmothers and pension funds, but they didn't pay enough yield for the gamblers. So Wall Street had billions of dollars of this BB-rated dross just sitting in warehouses.
You're describing a market inefficiency.
I'm describing a dumping ground. As the journalist Gretchen Morgenson put it, the CDO became the bin for the refuse of the mortgage boom. Wall Street realized they could take a pile of this unwanted, BBB-rated mortgage debt, throw it into a CDO, and run it through that waterfall all over again. And here is the magic trick. The rating agencies, Moody's, S&P, they would look at this pile of junk and stamp the senior tranche of the new CDO as AAA. They turned lead into gold.
Hold on. You're making it sound like they just arbitrarily stamped it. There was sophisticated math behind that decision, specifically the Gaussian copula models introduced by David X. Lee. The logic was based on correlation.
Ah, yes, the formula that killed Wall Street.
It was a tool for pricing correlation. The idea is simple enough. If you have a mortgage in Florida, a mortgage in Ohio, and a mortgage in California, what are the odds they all default at the exact same time? Historically, real estate is local. If Florida's market crashes, Ohio might be totally fine. So the model said that because the assets were diversified geographically, the probability of a total collapse, one that would drain the waterfall dry enough to hurt the senior investors, was statistically infinitesimal.
And that is precisely where the intellect completely detached from reality. The model assumed house prices were like coin flips, independent events. But they weren't. They were all connected by historically low interest rates and predatory lending standards. When the music stopped, it stopped everywhere at once. The correlation wasn't low, it was basically 1. But the crucial point here isn't just that the math was wrong, it's that the incentives were designed to ignore that the math was wrong.
You're referring to the rating agencies.
I am. These agencies were operating with 50% profit margins. And who paid them? The banks issuing the CDOs. So if Moody's said, hey, this pile of BBB subprime loans looks really risky, we can't give it a AAA rating, the bank would just walk down the street to S&P. It was a complete race to the bottom. They were paid to look the other way. You can't call that architecture. That's systemic corruption.
Okay, I will concede that the rating agencies were overwhelmed, and the conflict of interest is a valid critique. However, to say it was purely corruption, I think that misses the demand side of the equation. We were in the middle of a global savings glut. You had trillions of dollars from Asia, from oil-producing nations, all looking for a home. They couldn't just buy U.S. treasuries because the yields were at historic lows, 1% or less. These investors were desperate for anything that looked safe but paid a decent return.
So the solution was to manufacture fake safety?
It was an attempt to engineer a product that met a global need. The CDO bridged the gap between global savings and American borrowers. It lowered the cost of borrowing for everyone. If you bought a house in 2004, you got a low rate partly because this machinery was working. It efficiently allocated capital from where it was abundant to where it was needed.
But it allocated capital to people who couldn't pay it back. This is the most damning part of the CDO legacy, the originate-to-distribute model. In the old days, if a local bank lent you money, they kept that loan on their books. If you defaulted, they lost money. So they checked your income, they checked your credit, they cared.
The originate-to-hold model.
Sure. But with the CDO machine hungry for inputs, the local lender suddenly didn't care. They originated the loan and sold it to Wall Street 5 minutes later. The risk wasn't theirs anymore. It belonged to some pension fund in Norway. This broke the fundamental feedback loop of lending. We saw the rise of ninja loans, no income, no job or assets. We saw that famous case documented by Michael Lewis, the strawberry picker in Bakersfield, California.
I know the one you mean. Income of $14,000 lent $724,000.
Exactly. A man who didn't speak English, earning poverty wages, given $750,000. Why? Not because the bank thought he was a good credit risk, but because the CDO machine needed that loan. It needed the raw material to package into bonds to sell to the global glut. The strawberry picker was just a cog in a machine that had totally lost its moral and financial compass.
Okay, that is a striking example, and it was certainly a failure of underwriting. But I want to push back on the idea that this invalidates the CDO as a concept. You're conflating the fuel with the engine. If you build a Ferrari engine, a high-performance piece of machinery, and you pour sugar into the gas tank, the engine will explode. That doesn't mean the internal combustion engine is a flawed concept. It just means you use the wrong fuel.
But the engine was designed to run on sugar. You can't separate them. The structure of the CDO, specifically the opacity, it encouraged the bad fuel. By 2006, investors weren't even looking at the loans. They couldn't. A single CDO might contain slices of 100 other mortgage bonds, which in turn contain thousands of individual loans. It was impossible to do due diligence. They were buying the rating, not the asset. The complexity was a feature, not a bug. It allowed the banks to hide the fact that the fuel was toxic.
Transparency was an issue, absolutely. But markets evolve. We saw the market try to become more efficient with the introduction of synthetic CDOs. Now, this is where I think the genius of the financial engineering is most misunderstood. People hear synthetic and they think fake. But in finance, synthetic just means simulated.
I think fake was a lot closer to the mark, personally.
Well, hear me out. A normal CDO takes months to build. You have to go out and buy actual bonds, warehouse them, and structure the deal. A synthetic CDO uses credit default swaps, or CDS. It doesn't buy the bond. It sells protection on the bond. It mimics the performance without all the friction of ownership. It allowed for price discovery to happen at the speed of light. It allowed investors to express a view on the market without needing the physical assets to change hands.
Express a view? You mean gamble? This is where the CDO went from being a tool for funding mortgages to a massive, unregulated betting parlor. With a cash CDO, you are limited by reality. There are only so many subprime mortgages in existence. Once you package them all, you have to stop. But with a synthetic CDO, you can reference the same pool of bad loans over and over and over again.
You can take positions on them, yes. That is how markets find equilibrium.
No. That is how markets build a doomsday machine. Look, if I insure my house and it burns down, I get paid once. But in the synthetic market, all of my neighbors can buy insurance on my house burning down. Suddenly, you have 1,000 people hoping my house catches fire. You had deals like the Abacus 2007 AC1 transaction by Goldman Sachs, or the Norma CDO. These weren't built to fund housing, they were built to fail.
Now that's a harsh characterization. Hedge funds like Magnetar, who were involved in these deals, they were shorting the market. Short selling is a valid, vital function. It exposes overvalued assets. They believed the housing market was a bubble, and they used synthetic CDOs to bet against it. If the market hadn't been a bubble, they would have lost a lot of money.
But they helped create the very things they were betting against. Magnetar helped select the worst, most toxic assets to put inside the CDO, specifically so they could then bet it would explode. It's like a mechanic cutting the brake lines on a bus and then buying life insurance on all the passengers. It's not price discovery, it's predatory. And the scale of it, because these were synthetic, the notional value of the derivatives completely dwarfed the actual value of the real estate. That's why the crash was so devastating. It wasn't just that people lost their homes. It was that the bets on the homes were 50 times larger than the homes themselves.
I see the emotional weight of that argument, but we have to look at the aftermath with a cool head. The crash was severe. We saw Bear Stearns collapse. We saw Lehman Brothers vanish. We saw $542 billion in write-downs. It was an incredibly painful correction. But here is the crucial data point that gets ignored. Did the CDO die?
The market for mortgage CDOs certainly did, for good reason.
But the structure survived. Look at CLOs, collateralized loan obligations. These are the exact same structural waterfall, but they're backed by corporate loans instead of mortgages. That market is thriving today. It performed remarkably well, even during the depths of the 2008 crisis, compared to the mortgage stuff. This proves my core thesis. The waterfall works. The tranching works. The special purpose entity works. The failure in 2008 was a specific failure of U.S. housing assets and a black swan event, where safe assets suddenly acted like volatile ones.
Calling it a black swan is a total cop-out. A black swan is something unpredictable. This was entirely predictable if you just looked at the incentives. You mentioned efficiency earlier, but we have to talk about the cost of that efficiency. I mean, the fees. In some of these deals, 40 to 50% of the cash flow was stripped out to pay bankers and managers and lawyers before the investors ever saw a dime.
Well, high fees reflect high demand for a product.
High fees reflect a parasitic relationship. This wasn't about helping the economy. It was about fee extraction. And when you ask, did the CDO die? I say it just mutated. You mentioned CLOs, but we also saw the absurdity of CDOs squared.
A CDO composed of tranches of other CDOs. Yes, that is complex.
It's insanity. It's a derivative of a derivative. At that point, you are so far removed from the underlying asset, the actual business or homeowner, that risk assessment is literally impossible. It becomes a pure abstraction. You're trading math, not value. And when finance detaches from the real economy, it stops serving society and it starts consuming it.
Let me summarize my position then. The CDO, at its core, is a mechanism for capital efficiency. It allows diverse assets to be pooled and risk to be distributed to those who want it. The failure of 2008 was a failure of inputs, specifically subprime mortgages, and a failure of oversight from the rating agencies. But the concept of securitization, it remains a vital part of the global financial plumbing. It's a brilliant design that just requires responsible operation.
And I'll summarize by saying that complexity is not a virtue, it is a risk factor. The CDO severed the tie between borrower and lender, it hid toxic risk under layers of math, and it turned the financial system into a casino where the house rigged the game. As Buffett said, they are financial weapons of mass destruction. Innovation is valuable, but not when it serves only to obfuscate reality.
So a triumph of engineering versus a weapon of mass destruction. We may have to agree to disagree on that, but there's no denying its impact.
On that, we can definitely agree. It changed the world.
The markets have rebuilt and the structures remain. Perhaps we have learned to check the inputs more carefully this time. Thank you for listening to The Debate. We invite you to look at the architecture of risk in your own portfolio and decide, is it efficient or is it just obscure?